Hi, I'm here with Patrick Wolff. Patrick, I have a question for you.
Okay.
Would you consider insurance commissioner to be an insurance professional?
Yeah, actually, I would. It's a good question. Um, the person who regulates the insurance commissioner is the chief insurance regulator. And, fundamentally what you're doing is you're running a 1,400 person department. You are the ultimate decision maker on insurance regulation. And we're probably going to talk mostly about property and casualty, as we should, because that's, the market that's really in trouble in California, but it's also life insurance. And also some health insurance. And yeah, I think the insurance commissioner should be someone who really understands insurance.
But you don't need to pass the licensing exam to
No,
be insurance commissioner?
that's true. It's funny. But I love the question because, as you know, I took the time last fall to study for and pass my property and casualty insurance licensing exam. I think I'm literally the first candidate who's ever done that during their candidacy. And I'm not an agent, but it's a great way to get the real nitty gritty about how insurance works in California. So I was very glad to take the time to do that. By the way, what the legislature did last session while I was passing my exam, they actually stripped out the number of hours you need to study requirement. So they made it actually easier to study the exam. You don't need to know as much to take the exam. You don't need to know as much while I was studying and passing the old harder exam. Go figure.
All right. Well, you passed it. And so that's why I like you, that's why I like you as a candidate. You're actually taking the subject matter seriously. I feel like this is a role a lot of times for folks who are like, I'm elected to something and what's another thing I can get elected for?
Yeah, I think that's right.
So let me introduce you because I started in the middle. Welcome, listeners. This is Infill, the YIMBY podcast. We're here today with Patrick Wolff, who's honestly a really long time YIMBY. I first met Patrick when we still had an in-person office before COVID made in-person, obsolete. We
were in that crazy place on Natoma. Remember that?
Yeah, I mean, I guess it wasn't an inherently crazy place, but it was a crazy place for an office because it was actually just a giant garage.
Yeah, that's exactly right.
But we wanted some space and it was like quite cheap and Natoma Street is right in the center of things. But yeah, Patrick Wolff showed up at our meetings, interested in YIMBY stuff. I was a little surprised. He's a West Side single family home resident, but also a renter.
True.
Yeah.
True.
So he's been at YIMBY for this whole time, and now he's running for insurance commissioner for California. And insurance, I'm not sure if YIMBYs really realize it or think about it, but definitely in states like California, but states all over the country where climate change is accelerating natural disasters, insurance becomes a huge part of land use planning. From your point of view, why don't you tell us, how is the insurance market, or honestly in California, in a sense, lack of a market, impacting the housing situation?
Well, I mean, first and foremost, right? Like having home insurance or insurance for, whatever the structure is, the housing structure you're building or buying or living in. Obviously, that's important, but it's actually necessary a lot of times even to get a mortgage. In a normal functioning market, insurance should just be something you get. Like it should not be a barrier. But now in California, the availability crisis is so severe that insurance is actually many times a barrier. Condo owners report that they practically can't sell condos these days because buyers can't get the insurance, right? Obviously, that trickles down to building new supply. Sonja, you understand this better than anybody. Any supply side constraint, right, only adds to the cost and reduces the availability of housing in a market that we all know already is too expensive and too supply side constrained.
I think some people in their faith that things work in a smart way say, oh, well, the insurance industry will take care of that. If you're building something it's in a place that's going to burn down, they won't be able to get insurance. And so it just won't get built. But in California, we have mucked that up. Is that right?
Yeah, no, we have mucked that up. So, okay, so just sort of to recap, first, there's just straight out availability where insurance should just not be a barrier to buying, selling, building, housing in sort of any normal place. And it has become a barrier because of the crisis in California. But now let's also take a step back, right? There is already existing housing in places that are in the WUI, the wildlife urban interface, right? It might not be in the dense urban places that we'd love as YIMBYs sort of to see all our housing, but it's existing housing, right? The last thing we want is to walk away from existing housing. We need to make it work. And also, there's actually plenty of things that we can do to make housing safer, even if it is in more combustible places. And for all of that, you need an insurance market to work. First, you need it to price the risk so that you can really quantify what is the cost of that risk, not just today, but in expectation going forward. What is the cost of that risk of being in more flammable areas? And critically, what can we do to reduce the risk? Because there's actually a lot of things that we can do to mitigate the risk that's going up because of climate change. And some of those things need to be done at the government level in terms of land management. But some of those things are really straightforward at the level of the property. And a well-functioning insurance market will provide incentives. You'll actually have insurance companies competing to provide ways or guidance for you to make your home safer. And then with good regulation and good government intervention, you can help to finance that, to subsidize that, to sort of grease the wheels. So there's a lot where the insurance market really does play in housing in California.
Yeah, and to be clear, one of our missions at YIMBY is to densify existing suburbs, to integrate existing suburbs.
Absolutely.
And in the Bay Area, where I'm most familiar, the towns along the 24, like Orinda and Lafayette.
Yeah.
So the 24 is a highway, and there's BART stations all along. But Orinda is entirely a high fire zone, and Lafayette is almost all a high fire zone. So I really want to reemphasize that this totally matters for YIMBYs, because if we're serious about building more housing in Orinda, and people are saying, well, it's a high fire zone, so it's impossible. Or if the politics somehow worked out, but it was uninsurable, then that's a serious barrier to our policy goals.
Totally agree. I mean, my vision, I'm sure your vision too, just here in the Bay Area, is of a substantially denser urban footprint throughout the Bay Area. The last thing we need is, like you said, these areas where people live, where there's already infrastructure that we should be building and densifying, right? That somehow these should be uninsurable, off limits. That's crazy.
Yeah. So can you tell us, I mean, how is public policy aggravating this problem currently? And how does the insurance commissioner in particular remedy that or change the public policy?
So I'm gonna sort of wonkify for a few minutes. So
we love it here. That's
okay.
That's our audience.
Go too deep, but it's important to get a good background here. California's insurance regulation was created through something called Proposition 103. Proposition 103 passed in 1988 and put in place the regulatory structure that we have today. And without getting too deep in the weeds, it created a system that allows for very strict review of insurance company filings. And it also created a pretty robust regulatory set of powers that ultimately rolls up to the insurance commissioner. So to first level, what this means is powers can be very effective if used well, but it also can really gum up the works if not used well, or if just sort of allowed to play out without really being managed. And that's what happened over the last couple of decades. And very specifically, as climate change during the last decade, during the 2010s, as climate change was pushing up the risk of fire, of catastrophic wildfire, regulations in place were not updated. And the specific regulations were that at the time, insurance companies were required to predict the risk of catastrophic wildfire only by using a 10-year look-back historical analysis, not by using predictive forward-looking models. So in other words, essentially, the only model you were able to use was 10-year history, which, obviously climate change means change. So that...
My face. The
Exactly.
listeners cannot see my face. It's a bad one.
So this is a real problem. And the other thing for people to understand, right, is catastrophic wildfires they're lumpy. They happen in certain years, but they don't happen in other years, right? So the risk was going up, right? The probability was shifting in a more sort of smooth, continuous fashion, but the actual events only happened from time to time. And it was in 2017 and 2018 that we had some really bad fires up in the north here. And that's when the insurance company realized, okay, we have to be allowed to underwrite the risk differently. And the insurance department said no. And so from 2019, 20, really up to 23, 24, 25, insurance companies started pulling out of California. That's what created the initial availability crisis. Now, an additional regulation that was put in place, it was also not even put in place, an additional regulation that was in place, was sort of allowed to stay, were significant constraints in calculating the cost of reinsurance in your allowable rate of return. And I know we're getting super wonky, but basically reinsurance is a very normal process where insurance companies lay off, they purchase insurance for themselves to spread the risk throughout the system. It's very, very important. It creates more capacity. It's the most normal thing in the world. It's very, very foundational to how insurance works. But in California, because the insurance companies were not allowed to count that correctly, that was another impediment. And so because of those two impediments, you had insurance companies leaving for several years and the FAIR plan growing. Essentially what happened was the market just got sicker and sicker and sicker until it finally really came to a head, particularly in 23, 24. And then we had these horrible fires in LA, which exploded the problem. That's how we got here. Over the last couple of years, the Department of Insurance has now started to reform these regulations. And it's because of these reforms, we're now starting to get more insurance companies back in the state. But there's a lot more that needs to be done. There's some technical problems with the way that the current reforms have been implemented. And so the market is starting to heal, but there's a long way that needs to go. And all of this really goes to how incredibly important this election is and how important it is to have the next insurance commissioner be someone who really knows what they're doing and who's really committed to this. Because otherwise we could have a market that really continues to be very problematic or even get worse.
Just to be clear, the regulations, this is something the insurance commissioner has control over. Okay. Right.
Yes.
Because there's also separately, the legislature can also pass laws that regulate.
That's right. But a couple things are really worth emphasizing. First, about the legislature. So one of the things that Proposition 103 actually said in the text is that legislation can only, quote unquote, further the purpose of Proposition 103. And one of the consequences of that has been that legislation plays a very supporting role. It's important. I'm not diminishing the significance of it, but really the rules that govern how insurance operates in California are much more regulatory than they are statutory. They're much more determined by the Department of Insurance than by the legislature. And then in terms of those rules, look, obviously the insurance commissioner doesn't do this all by themselves, right? I mean, this is a department with 1,400 professionals, many of whom are lawyers that work on interpreting the regulations and promulgating new regulations and so on and so forth. But the policy decisions are ultimately made by the insurance commissioner. And it's a commission of one. The insurance commissioner does not report to the governor, does not report to the legislature. So it is this role that we kind of ignored for years, that within the specific area of insurance, is very powerful and very significant.
So why in the past, why were insurers forced to only look at the record
Historical.
of claims for the last, 10 years?
It's the way the regulations were promulgated. I honestly don't know the specific reason why they were promulgated in that way, but they were promulgated in that way and they were not reformed for years until very recently, like literally until last year.
Right. And there's a lot of kind of political questions I have about this. And one of them is, why, in your opinion, is it important to even micromanage that for the insurers? I can see why.
No, it's a very good question.
Yeah, I can see why you want to fight with them about rates or something. But why?
So here's my, no, you're asking an incredibly important, profound question. So here's my answer to your question for a couple different perspectives. First, the way I articulate my plan on my website, I have a detailed plan, but the way I articulate it's really around three big ideas. And the three big ideas are holding insurance companies accountable, increasing choice and competition, and improving transparency. The holding insurance companies accountable is about the regulation of market conduct, which is incredibly important. Like, insurance is a business where you give someone money so that one day in the future, if something happens, they give you more money. Like, that is a business that needs to be regulated. Like, I don't know any business in the world that needs to be regulated, if not that one, right? You really need smart regulation about how insurance companies behave. But the increasing choice and competition means reducing the micromanagement of the filings and in particular around the pricing. Now, in the current market, we have a very unhealthy market where some insurance companies do have market power. And if you have market power, then you do need strict review and the regulatory sort of oversight and pushback on allowable rates. But that shouldn't be the goal. The goal should be to have a healthy, competitive market where insurance companies are competing with each other and they're able to rapidly bring new product, new pricing to you, the customer. And again, with a very smart, strong regulatory oversight on how they behave, but let them duke it out on the pricing and the various ways in which they want to come to market. And I really want to emphasize that part of the trouble here is the Department of Insurance back in 2020, 21, 22, 23, they saw insurance companies leaving, but they thought, hey, we've got a couple of insurance companies that are willing to underwrite at the price that we like, so we're happy with that. But the insurance companies were underwriting an uneconomic price. And then they came back and said, no, we actually need to take a lot more price. And now we have this unhealthy market with insurance companies with market power, right? And we had this terrible disaster, and State Farm in particular is in financial trouble. And that's why they're treating their customers so badly. I mean, it's just a complete mess, and it's a complete misregulation of the markets. And I agree with you 100%, Sonja. It goes back to this foundational idea. We want healthy competition with the insurance companies with each other, and we want smart regulation of how the insurance companies behave to make sure that customers are empowered and there's transparency and so forth.
And to be clear, the part of the insurance behavior that you do think needs regulation, I guess I just want to make sure I'm understanding that you're referring to the fact that once the disaster strikes, you don't want the insurance company to be like, oh, well, actually, I don't have to pay out.
Correct. I mean, there's other things as well, but this is the most important. So there's a term that people use in the industry called delay, deny, defend. And the idea of that is you delay paying, you ultimately deny legitimate claims, and the insurance company makes the decision that they're going to defend in court because it's a business decision, right? So the regulatory, first of all, you need the regulatory oversight to have rules and enforce those rules. But then also you need the regulatory oversight to evaluate how insurance companies are behaving and provide that information to the customer. That's incredibly important, right, powerful information that the market will not itself generate, right? Because it's so opaque. As an individual company, it takes a very long time and so forth. The insurance department actually collects this information through what's called market conduct annual statements. And one of my policies is I want to make that information public because the insurance companies lobbied for years to keep it private at the anonymous at the company level. I want to make that public and provide each customer a report card on every single insurance company whether you're shopping or whether you're renewing. So you know how those insurance companies have actually been behaving on paying claims through the analysis and investigation of the Department of Insurance. Because again, there's a real big difference, but some insurance companies are much more inclined to do the right thing, and some insurance companies are much more inclined not to do the right thing. But if you don't know, if you're not empowered, you can't hold them to account. And that's an incredibly important role of the Department of Insurance.
Yeah, that's something they should compete on.
Exactly. But you need regulation to create that market to allow them to compete.
Right. Right. So like a consumer watchdog role. Cool. Very, very good. Very interesting. You mentioned that the insurance industry, of course, has lobbyists, and the lobbyists try to achieve certain goals. So that goes to my other question, which is in this world where the insurance companies were forced to use this backwards looking way of calculating risk, what was their industry response? Because to me, that seems like a place where industry goals and public welfare goals would have been aligned. You know, like, I mean, who exactly benefits from them calculating risk incorrectly? And were they lobbying to get that changed?
So this is a tricky question. Let me unpack it a bit. So first of all, I think just to describe what was happening, a number of insurance companies were leaving the state, but there were a couple of insurance companies that didn't. And State Farm in particular pushed the pedal to the metal and started writing a lot of business. And so we had a market that was becoming less healthy. Again, the FAIR Plan was growing. But I think at the Department of Insurance, they figured, well, we've got this big insurance company that is writing this business, so we're happy with that, right? So I think to some extent, like not really paying enough attention to the market structure was part of what happened. You're absolutely right that insurance companies were, as a group, unhappy. But I think there's an ideological perspective at the Department of Insurance to kind of view the insurance companies in a very adversarial way, which is not, because to some extent they are. It's a tricky industry. You're not always aligned here. But particularly in the rate setting process, I think there's been an ideology that's taken hold over a number of years where the Department of Insurance really does believe its job is to figure out the right price rather than to foster a healthy competitive market. And that goes back to this intervenor system. So California has a very unique review process. This, what's called prior approval, where an insurance company has to present its filing and get it reviewed and approved before they go to market. That is typical. In many other states have that. But in most states, it takes about 60 days for those filings to be reviewed. In California, it takes 305 days, and that's the median time. That's the median time, which means half the time it's taking longer. And you can imagine what that right tail looks like. There are situations where the filings are gummed up for years. And it's because the Department of Insurance thinks its job is to review every single filing, and in particular, to take these intervenor challenges and honor them no matter what. Even though the regulations, the Proposition 103 regulations, actually sets up a process that's supposed to streamline this much more. So the bottom line here, Sonja, to your question about why industry lobbying kind of fell on deaf ears, I think it fell on deaf ears because there's this ideology inside the Department of Insurance and this system that's been allowed to evolve over years that really has strayed away from the original intent of how the regulatory system was set up, which is why regulatory reform is so incredibly important here. And it's starting. It's starting. And there's a lot more that needs to be done. And that's why this election is so important.
Okay, so because the Insurance Commission does not have the attitude that prices are an important informational signal, that's why we're not getting those signals anymore.
That's exactly right. No, I mean, you nailed it. That's exactly right. And the one thing I would add to what you would say that I think it's really important for everyone listening to understand, the market doesn't just work by itself. Insurance is an old industry. The first insurance company in the United States predates the Declaration of Independence. And as per usual, Benjamin Franklin was involved because he did everything during that period of time, right? So insurance has always been a regulated industry and always will be. Smart and good regulations makes the market work well and provides those price signals like you're saying. But not good, not smart regulation can really muck it up.
Yeah, and I kind of can't resist, not that we want to talk about any of your opponents, but guys, Jane Kim is running, and it's just, especially in this context, I cannot imagine a worse person because of all, she has many lovely qualities, I'm sure, but one of her qualities is corporations are bad. Prices need to be controlled. If prices are high, it's because they're gouging you. Like there's no listening for the price signal with that candidate.
This is so right. This is so right. And I mean, this is the thing that it's so important. I know that everyone listening is going to understand this, but you cannot just set the price to what you want it to be. That's not how it works. You have to create the conditions where you get healthy competition with customers that are empowered. And then you need to align incentives and in appropriate situations, take direct government actions to reduce risk, to reduce cost. That's how you get prices lower. You don't just get prices lower by setting them. I mean, you can get prices lower just by setting them, but then you break a lot of things.
Right. Well, then you don't have the thing.
That's right.
What's the difference between something you can afford that's not available and something that's available you can't afford? You don't have it either way.
That's right. That's right. And with insurance, it may look like you have it for a little while, and then the disaster happens, and you realize how everything was misaligned and mispriced.
So speaking of disaster happens, what is the FAIR plan? And what's going on with it now?
So let's go a little wonk again. So the FAIR plan. The FAIR plan is a government mandated but privately run insurance. It's fire insurance of last resort.
So like CSAC.
So the way it works is every insurance company that operates in the state of California is required to participate in the FAIR plan. That's the government mandate. The FAIR plan is run by a board that is approved by the individual insurance companies. And that board runs the company. The FAIR plan, think of the FAIR plan as just an insurance company that underwrites and services insurance. Now, as you might think, any insurance company that's set up to be run by a board that's appointed by a whole bunch of insurance companies that normally compete with each other, that's probably not going to be the best run company out there, and it's not. But its function is to be fire insurance of last resort, only fire insurance. It doesn't provide all the other wraparound insurance of home insurance, just fire insurance. And the idea of it is to make sure that if for some reason you lose your home insurance and you're not able to get home insurance, you have a safety net. You have something that provides you that fire insurance so that it's available for your mortgage, so you're not in any sort of terrible situation. But the FAIR plan has terrible service, has terrible underwriting, and it hasn't mattered that much for a long time because it's been so small, but it's the insurance of last resort. And as California's insurance market has gotten less and less healthy, more and more sick, the FAIR plan has underwritten more and more people. It's now like 7+% of the state of California is by far the fastest growing insurance plan in the state. So the insurance companies participate in the profit and loss of the FAIR plan in the same proportion that they have market share in the state of California. If you have 10% market share in the state of California, you're 10% of the FAIR plan. If you have 5% market share, you're 5% of the FAIR plan. That's fundamentally what the FAIR plan is. And it's been growing over the last 5, 6, 7 years. And so it's now gotten quite large. And it's not pricing its risk adequately. And so the insurance companies are on the hook for those losses. In fact, just last year, there was $1 billion assessment that was made on all the insurance companies to pony up for the losses. But losses above a certain amount, which I can get into if people are interested, the losses above a certain amount are actually put back to policyholders not on the FAIR plan. So you actually have non-FAIR plan participants subsidizing the FAIR plan, which is obviously a mess. And the whole thing needs to be fixed. And ultimately, what we need to do is fix the regular admitted market and get people off the FAIR plan and back into the insurance that they need.
So if you have 0% of the market, then you are 0% liable. I mean, is having to pay for the FAIR plan also part of why insurers are just like,
yes.
quit? Yeah.
Yes, it has been an impediment. And it's because of that reason last year. So the Department of Insurance made $1 billion assessment, but they also created this bargain with the insurance company, said, okay, you'll have to pay the first in aggregate, you'll have to pay the first $500 million of all losses in the future. But then for the next $500 million to $1 billion, you could put half of those losses onto your customers by issuing surcharges. And then above $1 billion, you could put all of those losses on your customers. And that way, you know that your losses are capped. So by capping the losses for the insurance companies, they made it less of an impediment for the insurance companies. But obviously that's backwards. Like, that's ridiculous. What should be the case is the FAIR plan should have proper pricing for the risk so that it's not a burden on people not in the FAIR plan. But in order for that to happen, we need to fix the regular admitted market so customers actually have someplace to go and get insurance.
Oh my God. And so what kinds of places are on the FAIR plan now?
A lot of high risk, fire risk places, but a surprising amount of not high fire risk places because we've had this insurance availability crisis. And for many people, it's been the only insurance they've been able to get.
Yeah, as the insurers just quit, it means they're canceling everybody's policy, even policies that are in urban areas. I know several people who are homeowners who are like, what? My insurer is closing. What am I going to do now? And if you live in your home, it's a little easier. But if you own a home and rent it out, it can be actually really quite difficult to get insurance. And again, nothing to do with fire in like zero risk places that are urban.
Yes.
So, okay, the FAIR plan portfolio has all kinds of houses in it now. And so I guess if it has all kinds of houses, it's mostly existing housing because a really very small amount of housing is new housing. But do new houses go right on the FAIR plan?
It can. Absolutely. I mean, it's a question of what's available because remember, the FAIR plan is required to take everybody. There's rules. You have to show that you've tried to get a certain number of quotes. You have to demonstrate that. But once you demonstrate that, the FAIR plan has to take you. And so because our market is so broken, it's been taking a lot of houses all over the place, including new build.
Insurance of last resort is probably a good idea. I mean, it's social insurance. Like Social Security is also a kind of insurance of last resort or unemployment insurance. But how do other states do it? And is this way of having your insurance of last resort be run by the insurers, is that a good way of doing it? Or is there some other way that would make more sense?
Well, let me unpack a couple things in your question. So you're absolutely right. Social Security is a kind of insurance. It's basically insurance against poverty and old age, right? Which is very important. But the reason why that's run by the government is because we're trying to pool risk, but we're not trying to price it, right? We're not trying to have you pay commensurate to your risk of being in poverty in old age. What we're trying to do is pool the risk together and in fact actually subsidize the payment of that. And whenever you have pooling without risk pricing, that's when the government makes a lot of sense. But for property and casualty, you've got risk and you really want to price it. Now, remember the FAIR plan, it's government mandated, but it's not government run. It's run by these insurance companies. I think it absolutely does make sense to have a last resort fire insurance mandate plan, but it should be a small temporary stopgap. And that was the whole point of it in the first place. In fact, for people who want to do a little history dive, the roots of the FAIR plan go back to the Watts riots in the 1960s. And there was a period of time when insurance companies would not underwrite inner city, obviously predominantly Black-owned businesses and homes because they were afraid of riot risk, fire. And that is what the roots of the FAIR plan are in. It's interesting. Wow. But what it evolved into over time was this sort of last ditch temporary stopgap, particularly if you're in high-risk areas, which, again, I think there's absolutely a function for it. But we don't want it to be big. Like what we want is to have a healthy competitive market with lots of insurance companies where you just have a temporary stopgap when you need it, and then you get right back into the regular admitted market where you belong.
Gosh, that's so interesting. Going back to the Social Security example, the idea of charging people who are likely to be low income, to be in poverty in their old age, high insurance premiums while they're working is
obviously
absurd,
we don't want to do that.
because people are already incentivized to try to make more money if they can. The price of insurance is, as we've been talking about, it's supposed to be a signal. It's supposed to help you decide what to do. And we see it all the time, public pools or private pools. Like, they used to have a diving board, and they still can, but the price of the insurance is high, and so they decide not to do it. It influences what they do. They reduce risk by just being like, we're not going to have that risk. And yeah, so for housing, we really do want people to be influenced by their rates. Yeah, go ahead.
And I want to add one more thing, because I so completely agree with what you're saying about the price signals and where we really want them. It's not only to price the risk, it's also to incentivize companies to compete for ways to lower risk. So there are, for example, many ways to use technology today to lower fire risk. And I know when people think fire risk, they tend to think, catastrophic wildfire, but most fires are house fires. Most fire laws, it's only these extreme, exceptional events, these catastrophic wildfires, that create these lumpy, extreme risk events. But the ordinary course of the year, most fire risk is house fires. We want companies to be incentivized to compete for ways to find technology, bring them to market, and offer them to customers. If you use this technology and demonstrate you using it, will lower your insurance rate. That's exactly what a competitive market can do. And as you know, Sonja, oftentimes you don't see the lack of that. Because when you don't see that competition, you don't see that innovation, it's just business as usual. You're not seeing what you otherwise would have to imagine. Just like in housing, we're not seeing what we're not building. And so you get these NIMBYs that say, like, oh, well, it can't be done anyway. So, no, of course it can be done. Yeah. We just need to get it to work.
So another complaint I've heard is that there are things to reduce risk of fire in and around your home, mainly around your home, like creating a defensible space or even different sorts of material upgrades. People complain that although they invest in those, they aren't really getting a discount on their rates, or they're not getting as much as they expect.
Yeah, no, this is a big issue. So let's dive into this for a bit. The Department of Insurance has a program called Safer from Wildfires, which is supposed to provide guidance to homeowners about how to reduce the risk. And also mandates that insurance companies give discounts if you do certain actions. But there are problems with how the program is structured. First of all, the actions that the Department of Insurance lay out are not very well aligned to how insurance companies actually underwrite. So it's a case of the Department of Insurance trying to dictate what they think insurance companies should recognize, rather than drawing out from the insurance companies what they will recognize. I'll come back to that in a minute. But the second issue is they are mandating discounts for each individual action, but the science actually says you have to do these together in bundles, because if you only take one action or another action, you haven't actually reduced the risk at all. And so the insurance companies have gotten around this by offering token discounts. And so, of course, customers and homeowners are very frustrated that they're being told they should follow these guidelines, and it's not resulting in discounts and so forth. There was recently a report, an SB 254 whole wildfire report. It's really fascinating reading for anybody who wants to dive into it. It was published about a month ago. And that report calls out this issue. And one of their recommendations is that instead of discounts being tied to individual actions, there should be bundles like tiers of like bronze, silver, gold. And also the guidelines should be more closely tied to the science rather than dictated by the Department of Insurance. And I agree with those recommendations as far as they go. But I actually think there's an even better way to structure this. And I think the right way to structure this is, instead of telling insurance companies what they should recognize for discounts, we should instead mandate that every insurance company that offers home insurance has to provide guidance. So, like, if you want to write in the state of California, you have to provide some kind of meaningful guidance as to what actions you can take and discounts you'll provide, and make insurance companies compete on that. So because it's a mandate, they all have to do it, but you don't tell them what they have to do.
Right.
Just make them find different ways to provide that guidance and so forth, and then have them compete on that. And the insurance companies that do a better job will get more business. And then, as a partner with that, I think there is appropriate financial assistance that should be provided to homeowners. And the Department of Insurance was authorized through a law. It's called AB 888 that passed in the last legislative session. The Department of Insurance was authorized to develop financial assistance programs with money attached to it, which is why it need to be authorized by the legislature, which I think is incredibly important because there's a public good component to hardening your home. The market doesn't incentivize the actions you need to take sufficiently, because part of the good is not just hardening the home for your own safety, it's hardening your home to create community safety. And economics teaches us that public goods is exactly what we should be subsidizing with taxpayer dollars. And so that's why appropriate financial assistance, in addition to equity consideration, that's why, just on a pure efficiency basis, that's why we need to develop those programs.
Yeah, gosh, that's so interesting. To give an example, maybe you need to redo your roof. I think it's easy to imagine that even if that reduces your insurance premium, it might not reduce it enough to make it worth it for you to do it. A lot of people,
Correct.
or you don't have the cash on hand, or even maybe it does. If you don't have the cash on hand and for whatever reason it's hard for you to borrow, there's a gap there. So
Exactly.
that seems like a role for public.
And critically, the harm to not doing that is not just to yourself.
Right.
It's also to your neighbors.
Right. Your neighbors don't want your roof on fire either.
Exactly. Because then the embers will fly off and burn their home.
Oh my gosh, this is all so fascinating. I'm
It is.
learning a lot and like getting tired of learning. There's two things just before we wrap up. One, we're really only been talking about one kind of insurance, but is there anything you want to talk about with the other insurance markets, like auto and
Yes.
health insurance and stuff?
I mean, oh my gosh, yeah, there's so much to talk about. So first of all, with auto, there's a very interesting opportunity, I think, and that's to explore allowing the use of telematics. So telematics refers to a set of technologies that basically allows insurance companies to record your actual driving behavior to underwrite your risk. All 49 other states, and I think District of Columbia too, allows customers to opt in to the use of telematics. California is the only state that does not allow it. Now, the reason is because we have privacy concerns, and I want to be super clear. Privacy is a big deal, and I take privacy very seriously, right? It needs to be completely opt-in. The data needs to belong to the customer. That data needs to be anonymized as much as possible to allow for underwriting, right? So that you have the particular data to you, but the insurance company does not have the particular data to you. They just have the data they need to underwrite. There needs to be strict prohibition on the ability to share. Under no circumstances should they be able to sell that data. And probably they should have to destroy that data after some period of time, again, commensurate to what they need to do underwriting. So the privacy is super, super, super important, and we need to get it right. But I'm confident we can get it right. And if we get it right, what we're doing here is we're leveraging technology to allow for not just more accurate underwriting, which means lower auto insurance bills and better price signals, but there's also public good to having that data. Two things in particular. One, it's been shown that having that driving data leads to better driving. It leads to safer driving, which is obviously just a good all by itself. It reduces the risk, reduces the cost, but also just saves lives. Like that's a good thing. Also, When you have that data, it's your data. You now have something that can protect you against biased policing. So if somebody pulls you over for driving while black or driving while anything else, and it's not warranted, you now have objective data to say no. So there's a lot of good here, and I think that this is something, if we get right, could really be a net benefit. So that's auto insurance. Let's talk about health insurance briefly. The weird thing about health insurance in California is almost all health insurance is regulated by what's called the Department of Managed Health Care, which actually reports up to the governor's office. There's a whole long history to that, no need to go into. But the Department of Insurance only oversees something like 4 or 5% of all covered lives in California. It's really weird. But one of the things I think is a huge opportunity is the policy wonks that have looked at this for some time, but especially after the passage of the Affordable Care Act, there's been broad agreement that this split insurance regulation, health insurance regulation, is bad. It does not serve the people of California well. For example, Scott Wiener passed back in 2020 a mental health access bill. It was a major piece of legislation, which is a very good thing. And it took 5 years for the Department of Insurance to finalize its implementing regulations, which is insane. And it took that long, partly because there was this harmonization that needed to be done with the Department of Managed Healthcare. So having these two different agencies actually just really gums up the work. And so one of the things I've committed to is I will work with the legislature to develop legislation that would move that into one entity where it belongs. And I'm perfectly happy for it not to be in Department of Insurance. I have zero interest in turf defending here. All I want is to get this right the way it should be. I believe I'm the only person who's committed to this, and again made very clear I don't care about staying in my sandbox. I just want to make sure it's structured in the right way for people. And then for life insurance, there's actually a bunch of stuff going on. Sonja, nobody cares. Nobody's interested in talking about life insurance. I never get any questions about life insurance, but there's a lot going on, and you really want someone in this office who understands the financial risks, because the next insurance commissioner is going to need to stop life insurance companies from engaging in certain kinds of financial shenanigans that have allowed them to take more risk. And because they're taking more risk, they're ultimately putting policyholders in jeopardy. And I've got this laid out on my website if anybody wants to take a look and read my statement of the problem and what I intend to do about it.
Okay, well, that's interesting. Yeah, I guess the thing about life insurance is it just sort of reminds you that you're going to die.
But I think the other thing about life insurance is it's not systemically important in the same way that property and casualty is, right? Like when the home insurance or the auto insurance market breaks, it breaks everything. The life insurance market is more just sort of its own thing. But it's a part of the job, and it's an important part.
Yeah. No, I mean, life insurance is super important. If a loved one dies, that's a chunk of money that people need. I mean, that's
100%. And God forbid that the money that you give to your life insurance company turns out to be at risk.
right. 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 Okay. So last thing, how can people get involved in your campaign? What do you need? And what should people do if they've listened and been like, wow. So look, the other thing too, this is a national podcast. Maybe make a little pitch about why it's important, why people who live in DC or care about the national health of our country should be caring about this race.
Well, I would say one thing, which is it's not just that our insurance markets are screwed up. It's that the fact our insurance markets are screwed up is screwing up a lot of other things. And housing is one of the things that's really screwing up. If you care that California really gets YIMBY and really builds more housing and really lowers the cost of housing, then you want everything to be firing on all cylinders. And you do not want California's insurance system to be an impediment. But it is right now. And so if for no other reason than just the success of the YIMBY movement, what happens in California's insurance markets matter. And so that's why I hope, of course, for those of us living here, it's super important. But I hope for people who are living elsewhere, who's passionate about the YIMBY movement, who cares about making sure that we build more housing and lower the cost of housing, make housing affordable and available. I hope you care that the insurance markets in California really work and get out of the way and just facilitate rather than be an impediment.
The other thing, too, is that for the greater community of folks who care about good governance,
yes,
you want somebody who's good governance in this very important position in, what is it?
Whether we're fourth or we're fifth in the world, I lose track.
Right.
We're big.
We're big. Yeah. So you really want somebody who's talented and thoughtful and actually into governance and solving problems and not some kind of empty-headed, okay, I need to run for something.
Well, I really appreciate that. And you and I have been friends for a long time because we've been in the trenches together for a long time. So I'm very appreciative of that. I do want to emphasize this is a role that has been treated as a political stepping stone for years. And we have to stop. This role matters. And I'm not going to run for any other elected office after being elected insurance commissioner. I am not doing this to launch a political career. I have no fantasies about being governor or senator or anything else. It would be the honor of my life to serve for the next 8 years as insurance commissioner and really get it right. That is what I want, and that is why I'm putting myself forward.
Well, thanks so much for doing it. And so what's your website?
PatrickWolff.com is 2 F's, PatrickWolff, PatrickWolff.com. And my social media handles are @Wolff on your side. Wolff on your side.
And this is a race where really money is the thing, because this is really run on mailers and name recognition. And although if you're in California, it could be cool to do door knocking. It's mostly going to be money. But you know what? Tell your friends, because this is the type of race that people are like, I don't know, right? So if your friends know you as someone who follows politics, your endorsement is more than other endorsements, right? Like I can kind of tell people like, oh, I think you should vote for XYZ person for governor, but they're more likely to have their own opinion. But with insurance commissioner, if you tell your friends and family, Patrick Wolff is our guy, 90% sure they're going to be like, great, didn't know how to answer that question.
No, I mean, that's totally right. And something that I'm very proud of. I'm not a politician, which means I've not been getting the endorsements of elected officials and special interest groups. But you know what? I'm starting to get the newspaper editorial board endorsements. So there's 4 major editorial boards in California. And I've gotten the first one, which is the Orange County Register and all the Southern California News Group newspapers, which is more than 6 million weekly digital and print readers in Southern California. And I'm also going to get the second one. I got the call from the Sacramento Bee.
Congratulations.
Yeah, thank you very much. So that's 2 out of 4. The other 2 are the San Francisco Chronicle and the Bay Area News Group, like San Jose Mercury News and the rest. I don't know what's going to happen with those yet. I'm fingers crossed, but I'm very proud of the fact that the first 2 of the 4 editorial boards have endorsed me. And I want to emphasize, they've endorsed me even though I'm not a politician. They've endorsed me even though my opponents are politicians who have political records. And they looked at us, they interviewed all of us, they analyzed our plans, and they said, this guy, Patrick Wolff, who's never run for anything before, he's actually the best one. And I'm incredibly proud of that.
Congratulations. Okay, well, that's great. Looking forward to good news. And thanks so much for coming on our pod.
Thank you so much, Sonja. It's been a pleasure.